Good afternoon, everyone. This is Anthony Alaka with Torrey Hills Capital, and welcome to the Millennial Precious Metals webcast for October 6th, 2022. Hope everyone's doing well. Thanks for taking the time to join our virtual lunch. Many of you are already familiar with Millennial Precious Metals, having been introduced to the company about 10 months ago, but a lot has happened in that time, and we're happy to have management on our webcast today to give us a brief overview of the company as a little bit of a refresher, I guess, and to discuss recent developments and the outlook for 2023 and beyond. Just a quick refresher, Millennial Precious Metals is a Nevada-based exploration company with 7 properties in Nevada and 1 in Arizona. The company has been engaged in an aggressive drill program at its key assets with a PEA expected early next year. We feel that the company is well positioned to become a multi-million ounce producer. The company trades on the OTC market under the ticker MLPMF and on the TSX Venture under the ticker MPM. Currently trading with a market cap of only about $30 million US. They have a very strong balance sheet, high percentage of institutional and insider ownership, and the stock is trading at a discount to its peers. So we feel that there's plenty of upside as the company continues to execute its strategy. And gold has had a nice little rebound here from the lows last week, but we feel that the current outlook for higher inflation bodes well for gold prices over the long haul. And Millennial Precious Metals, I think, is well positioned to benefit from the positive outlook for the space. And really now is the time to consider adding precious metal stocks to your portfolio, with the outlook for inflation and the outlook for higher prices in gold. So with us today to discuss Millennial Precious Metals operations and growth strategy going forward is the company's Vice President of Corporate Development, Jason Banducci. Welcome, Jason. It's great to have you on today. And thanks for taking the time to update our viewers on Millennial Precious Metals. I know a lot of exciting things have happened over the last 10 months, and a lot of exciting things are scheduled to happen in 2023 and beyond. So I'm really excited to have you share those with our group today. Before I turn it over to Jason, I just want to mention everybody knows the format, I think, at this point. So if you have a question during the presentation, simply type it into the Q&A or chat box, and we'll make sure it gets answered. So with that, I'm going to turn it over to Jason Banducci. Jason, the floor is yours.
Thank you, Anthony, and thanks for all the viewers that have tuned in. Hopefully we can move through this presentation in about 20-30 minutes and leave lots of time at the end for questions. But anyways, for anyone that's unfamiliar with the story, we are a Nevada-based precious metals exploration and development company, and unlike some of our peers, we are very focused on growth. It's a brand new company. We've only been in existence for just over a year and a half, and look, I think at the end of the day, we bring a very unique value proposition to what can be a tough industry to really look into. There's 1,500 different companies exploring for precious metals on the TSXV right now. So hopefully in the next 30 minutes, I can explain to you why we're different and why we're worth a look. So before I get going, just going to draw your attention to our disclaimer. We'll be making forward-looking statements. So if you have any questions or if you'd like to read it, the disclaimer is in our corporate presentation and can be found on our website. So who are we? As I just mentioned, we're a brand new company, but what we're trying to do here is build a multi-million ounce, multi-asset production company. And we are focused on near surface heap leachable ounces in the world's top mining jurisdictions. So we've got assets in Nevada and one down in Arizona, which are consistently ranked some of the top places in the world for mining investment. And that's by design. When the founders put the company together, these are people with global mining experience, have done exploration and production in all corners of the world. And as the world continues to get crazier and crazier, right? And we just saw there was a coup in Burkina Faso. So all the, Western African-based mining companies are putting out press releases telling everyone that, nothing's been impacted. But, you don't have to worry about that kind of stuff in Nevada and Arizona. And that's why we're focused there. As I mentioned, we're focused on near surface heap leachable ounces. And that's for 2 reasons. It's low cost of discovery. And these are low CapEx operations to build and to operate. And so, in this world of rising costs and inflation, these are the type of projects you want to be looking at because they're the least susceptible to the cost rising. A big thing I want to mention is, again, the third bullet on the right here is these assets have not been in the public markets for 10 years. I joined the company shortly after we went public, but these were assets that were held in a private equity firm, and we're essentially out of the capital markets for 10 years. So it's truly a brand new story. So if you take a step back, we're going to focus on our Nevada-based assets, and we're going to primarily focus on these two assets here, Mountain View and Wildcat. Those are our two assets that are closest to development. The rest of the assets, Dune, Eden, Mar, Ocelot, and Red Canyon, are a little bit earlier stage, pre-resource. And so the story I'll focus on today is how, as an investor, you're going to make money on the re-rate that we see coming from the development of Wildcat and Mountain View. And essentially, as an investor, right now, you get the rest of the portfolio for free. So taking a step back, looking at, the company as a whole, we've got, a team that's behind 59 million ounces of global gold discoveries. Key metric there is that's across 7 projects, 5 of which are in construction or production. So they're real projects. We've got a diversified portfolio, as I mentioned, 8 assets, 7 in Nevada, 1 in Arizona. We've got a current 1.2 million ounce inferred oxide resource, and that's across Mountain View and Wildcat. And we've recently completed a 20,000 meter drill program, which was focused at Mountain View, Wildcat, and we did a little bit of drilling at Red Canyon as well. So this is actually a brand new slide. I just put it in yesterday, so I haven't presented on it yet. So you'll have to bear with me here. But I'm sure Anthony, earlier this week when Jason made a presentation, our CEO, he was talking about that, like, while we're in the business of precious metal exploration and we want to grow the resource, and that's all great, the other side to the business is risk mitigation. And as we de-risk our assets, you should see value reflected in the market, right? We're removing key risks. And if you look at open pit heap leach projects, there's 4 big risks you want to look at from an investor. So for all the viewers who are on this call right now, these are great things to write down. These should be part of your investor toolkit as you look at investing in new companies that have open pit heap leach projects. So again, the 4 big risks are metallurgy, resource conversion, geotechnical, and scalability. Can you actually grow these things? And so in the boxes, I've just tried to highlight what we're doing right now upfront to remove those risks. So for the metallurgy, right, like what kind of recoveries can you see in these projects? We're removing that risk upfront. We're doing PFS style work that'll be reflected in the PEA next year that'll remove that risk, right? Because if you run your models, if you look at these projects, if you run them at a 60% recovery versus an 80% recovery, there's very, very big impacts on the value of the projects. Resource conversion, again, we just finished 20,000 meters of drilling. About half that went to Wildcat and Mountain View. And again, that's to show resource conversion from inferred to indicated. And we'll show you that in the resource update next year, early next year. Now, another big risk is geotechnical, right? And that has to do with how steep can you make the walls of your open pit? Because if you have less rock competency, you've got to open up the pit to be less steep, and that means more waste rock, right? So again, that impacts your returns. And so we've done 10 holes. We're doing, again, going above and beyond to remove that risk. And the last one is scalability, right? Like we've got 1.2 million ounces now, but we want to show you and show the market how we can significantly increase that. And what we're doing is, again, we're doing all the baseline work to get the next phase of permitting, which is the exploration plan of operations, which allows us to step out from the 5 acres we're currently operating on. So Anthony, you'll have to give me some feedback later, but again, I think it's really important to focus on, why not to invest? What are the key risks? And we've outlined these to be the key risks that face these types of projects, and we're doing everything we can upfront, aggressively removing those risks.
Yeah, I think it's a really effective slide to really kind of drive home the fact that this is a de-risked company, and I think it's a great side.
Yeah, and that, the reality is we'll get into it later, but there's a reason why companies like GSV got taken out for 60, $100 an ounce, and why we're only trading at 20. And it's because we're doing the work right now to remove those risks. Everything we're doing is basically showing us that within the next 6 to 12 months, we'll have a box checked in all these quadrants, and we will see that re-rate in the market. So from an investment standpoint, it's a great time to be looking at the company right now, because we haven't checked all those boxes yet. So quickly, we'll touch on who the team is. So myself, Jason Banducci, I'm the Vice President of Corporate Development. My background's on the finance and capital markets side of the business. I spent the last 8 years on the banking side, the last 5 of which in mining investment banking. So, I sat on your side of the table. I was evaluating mining companies and mining investments for the last, almost decade. And this was the one I ended up making a career change for. And that's due to the quality of the projects and the quality of the people. And, I think case in point, we were able to raise $16 million Canadian in May of this year, when a lot of companies couldn't raise a dollar. And so I think, those are your 3 big box checks when you're looking at companies as opposed to assets is, people, quality of the project, and for pre-revenue exploration companies, can they raise money? And I think we check all those boxes. Some of the other key members of the team, we've got Jason Kosick, who's the president and CEO. He's a structural geologist by trade. He also spent years doing my job, so he's got a very good handle of the capital markets. I think one of those few people in the industry that can wear both hats. He cut his teeth with Anglo Gold, the Osisko Group, Talisker. He spent some time with Minera Alamos as well. So, we're very lucky to have him leading the company. Another, key management personnel is Rafael Dueto. Rafael is our VP of exploration. He's a PhD in resource optimization and geostatistics. He spent the last 10 years at Anglo Gold. On our board of directors, we've got Ruben Padilla, who's a brilliant geologist. He was one of the key geologists at BHP, Anglo Gold. Same with Terry. Ruben is the CEO of Sable Resources. Terry's the CEO of Talisker. We've got Mike Leskovic, who's a CFO of Nighthawk and works with Northfield Capital. Sarah Heston's a business professor at Stanford, and Eric Tremblay was the GM at Canadian Malartic, which is Canada's largest gold miner. I actually think it is. So, very well-rounded team. We've got the technical and financial capability to advance these assets, to raise money, and we believe to put them into production if we end up being the people to do that. So from a corporate profile perspective, we're very proud of our institutional shareholders. These are some of the top institutions you'll see behind mining companies: Merck, Franklin Templeton, Eric Sprott's in there, Crestcat, which does a lot of videos and content talking about our company, and they're specifically focused on Red Canyon. I'll get into that a bit later. But you can see we're 65% held institutionally, very small retail float. Waterton, who we bought the assets off of, is a private equity company. They took 19.9% of the company when we went public, and we've been slowly removing their ownership blocks and placing them with key institutional shareholders such as Franklin Templeton. We've got $13 million of cash on hand. As I mentioned, we raised 16 million Canadian in May of this year at a price of 40 cents Canadian. And that was a unit deal, so half warrant that strikes at 55 cents for 2 years. And then from an analyst coverage perspective, again, I think, we're covered by 4 brokers. There's lots of research. We put out some drill results this week, and immediately saw research comments from all of them. And Anthony, I think you have most of the reports. I can send you an updated dump of research, but if anyone on the call would like access to any of the reports, just reach out to myself or Anthony.
Yeah, and I appreciate that, Jason, because I do like to send it in the feedback. So if you have anything new, send it over.
Yeah, a bunch of the guys put out some notes on the recent drilling, so I'll send that across.
Great, thanks.
So, we, as the name states, we are millennials. Myself, I'm 33, Jason Kossik's 35, our VPX is in his late 30s. And again, as millennials, we're trying to lead this company differently than a lot of mining companies. And we are thinking of tomorrow today. And like, look, the industry has not done a great job in the past of being leaders from an ESG perspective, but in everything we do in all the communities we operate in, this is top of mind, and we're going to be putting out an ESG report next year that will grade us and hold us accountable to making sure we're good stewards of all the environments we operate in. So I'm going to quickly touch on the assets. I won't get into the technical stuff. My background's more on the finance side. But if anyone does have technical questions, I'm generally surrounded by geologists, which is a good and a bad thing. But if anyone wants to get into the technical side of either the assets that I talk about now, or even some of our periphery assets as part of the portfolio, we're happy to set up a follow-up call. So Wildcat and Mountain View, as I mentioned, form the development stage portion of our portfolio. Wildcat is the larger. We think both have a lot of potential. We think we can get Wildcat to a point where even as a standalone asset, it's a company maker. Right now, it's about 780,000 ounces at 0.4. But basically no strip. And that's, we'll get into later why that's so important. But that was one of the reasons that we were so attracted to this asset right at the get-go. And I will note, those are pit constrained ounces. So those are run at a $1,500 pit shell and with various mining costs associated to create that whittle shell. So Wildcat, we just recently wrapped up drilling at, as you can see, it sits right at surface. So this green line on the top right shows you what's currently within the pit shell. Everything below that sits out of the pit shell. As you can see, there's a ton of room to grow this thing. So we recently, as I mentioned, wrapped up drilling. We drilled 12 holes, 1,250 meters. And it's focused, again, the focus was on geotechnical and metallurgical data, so we can remove those key risks and use that to feed the updated resource and PEA early next year. And that also includes resource conversion and resource expansion. This was the first time we had drilled it because obviously, we just bought the assets. We drilled Red Canyon first, then Mountain View, then Wildcat. And it was a hugely successful program. I mean, our geos have identified a 1.2 by 2.3 kilometer footprint. So, as you can see, we're operating on a very small part of the land package, 5 out of 17,000 acres. And even on the drilling we've done, right, the grades are confirming the historical data. There's no overburden coverage. So in a mining scenario, you're basically just scraping the top off a mountain. You don't have to, it's not underground. There's nothing above, there's no overburden. So even when you go and walk at site, everything you step on is ore. It's all economic.
And Jason, can you talk about just quickly? So you have the pit outline. When do you see yourselves getting below that outline to see what else is down there? Because it looks like there's some potential for
So
some.
we're drilling. I mean, again, I'll show you on the right here. We will include that in the updated resource. We drilled through that preliminary oxide pit this year. So
Okay.
we're going to use all the drilling we've done in phase 1 to help feed the updated resource. And we can bring some of that additional mineralization in. And that's, again, growth within the current pit. That doesn't account for any growth outside of the pit. So that's none of this 1.2 by 2.3. That's all going to have to be drilled once we get the updated permit. So there's going to be really 2 phases of growth. One, now based on the drilling we've done, and we'll permit on that, and then we'll go back with phase 2 and really step out. Based on the drilling, some of the other great things we're seeing is we're starting to see indications of a much larger feeder zone, which we've talked about, Anthony. The rock competency is great. So like we talked about, right, you can get steeper pit walls, less strip, less cost, better margin. And another big thing is the oxidation profile is deeper than we've modeled. So that means, to your point, that we can bring in more oxide ounces into the resource update. And so you can see hole 3 and hole 4, 40 meters at 1.26. Keep in mind the resource grade's 0.4. We can make money at 0.4, and we're showing really nice intervals at multiples of the current resource. So all really, really, really good stuff. Another slide, just highlighting some of the drilling we've done. It's feeding the same narrative. We've got big intercepts of grades that are above and beyond the resource. We're seeing oxide mineralization outside of the resource, so 50 meters outside of the current pit. So we're going to be able to grow this thing, not a question. And all the drilling we've done up to date in this phase has basically been all positive feedback. And again, we're going to show and remove those big key risks. It is scalable. The metallurgy, we're doing the work. Initial work looks very good. So we'll remove that risk. Geotech, as I mentioned, this thing sits at surface, so that's not an issue. And so again, all those big risks you see with these projects, we're not seeing any major issues, which is great at this stage. I'll quickly there's some nice pictures of what it looks like at site. You can see, again, everything's right on top of a mountain there, but very easy to access. There's nothing around. There's no animals. There's no vegetation. We're in the middle of the desert, which is great from a mining perspective. We've increased the land package, doubled it. Again, you can see this red outline on the left is the pit. That's where we focused our drilling, but you can see how much growth potential there is there to significantly grow the resource. Second asset I'll touch on is Mountain View. And again, Mountain View and Wildcat will be developed in tandem. They will be put into production one after the other. We'll process at Wildcat and truck loaded carbon from Mountain View to Wildcat. But essentially what I'm saying is you can think of them as one combined project, and we'll be able to develop them and actually save significant costs by moving them together, moving them forward together. Same as Wildcat here, we're looking at $1,500 pit shell. So we've got slightly higher grade here, 0.57, 430,000 ounces right now. And it's slightly higher strip, but we'll explain on the next slide why it's actually not such a bad strip. What I mean by that is you can see this yellow material on the top of the cross sections. What that is it's an alluvial, so it's sand and gravel. So you're not blasting and drilling that to remove it. You can literally just go in with a backhoe and scoop it out. So it's not going to be $2 a ton mining costs. You're looking at $1.50. So we wrapped up drilling at Mountain View back in, I think it was May, and it was 27 holes, 7,200 meters. Same sort of observations that we're seeing at Wildcat. The grades that we're seeing are confirming all the historical data. You know, we feel like we've potentially discovered this feeder zone, which never been done. You know, you can see hole 400 at a depth of 185 meters. We intersected almost a meter at 141 grams per ton. So we feel like we're getting close to the feeder zone, which has the potential to be a company changer. Overburden, as I mentioned, is a sand and gravel, so it's a lower cost pre-strip. Deep oxidation profile, and you can see based on the images, it's the rock's very busted up. So this is going to be very good from a processing perspective, because even when we're mining it, it's going to get broken up enough that we think we should be able to process this run of mine. So we're not going to have to crush it, which again helps your margin. Quickly, we'll just touch on some of the other drill results, but as I mentioned, you know, you're seeing big intercepts of grades that are exceeding or meeting the resource grade. So all very good stuff. And you know, we're seeing, again, we're drilling through the pit shell and ending in mineralization, which means that we'll be able to grow the size of the resource at the next update. And again, within the 5 acres of surface disturbance we're currently operating on. Once we get the updated exploration plan of operations permit, we'll be able to step out and systematically grow it even further.
Yeah, and just to put it in perspective, if you don't mind going back to that slide, if you look at some of these holes, you know, these results are fantastic. I mean, especially if you look at like hole 24, which is you know, 121 meters to 306, you know, 1.48 grams per ton. I mean, that's pretty significant, don't you think, Jason?
It's extremely significant. You know, you look at the average grade in the Great Basin is like 0.4.
Yeah.
Right. So we're seeing wide intervals, 185 meters at 1.5, 232 meters at almost 1 gram. So yeah, they're very, very, very good. You know, it's a tough market right now to put drill results out in, but you know, internally, every time we get assays back, you know, we're very excited and pleased with what we're seeing, because we know more and more that these are going to be real mining projects.
Yeah, for sure.
So similar to Wildcat, we've done a lot of work to increase the size of our land package, and again, that's for 2 reasons. Same at Wildcat. One, so we can grow the resource bigger. We're seeing a lot of signatures at surface and evidence at depth that these deposits are open in certain directions. So we want to make sure we stake claims to have optionality to drill that. And the second reason is because we want to make sure we're staking claims that give us access to road and infrastructure, because we want to be the ones to put these assets into production. And so we're going above and beyond now to make sure that we clean up the land packages, secure water, advance permitting, do all the right stuff, because we want to be the people to build these things. I'll quickly go over Red Canyon. This was an asset that came out of a private landsman, so not part of the package we got from Waterton. This asset's located 30 kilometers south of the Cortez complex, so the most productive gold complex in Nevada that's owned by Barrick and Newmont. This was the first place we drilled. We drilled 12 holes, 2,300 meters, and these are some of the most spectacular drill results you'll see in Nevada in the last few years. As I mentioned, this asset's pretty well covered by the team at Crescat. You know, they love our other assets, but this is the one that they're pounding the table on. This is a Carlin style deposit versus the rest of our assets, which are low sulfidation epithermals. So Carlin style means it's going to be difficult to drill, but this has the potential of being, a multi-million ounce deposit, really a company maker as well. So we're lucky. We've got a couple of company makers within our portfolio.
What do you think is
Sure, go ahead.
Is reflected in the current valuation? Do you think it's just Mountain View and Wildcat, or is it part of Red Canyon as well?
I would say it's probably 90 to 95% Mountain View and Wildcat. I think some people pay attention to Red Canyon. I think if you look across the analyst reports, some of the analysts give it, a little credit, an exploration credit. So a couple $1 million, $10 million, but the majority of the NAV value right now comes from Mountain View and Wildcat, and for good reason, right? These are two assets that we can actually advance into production a lot sooner than a Red Canyon, Dunedin, Mar, Ocelot.
Yeah.
You basically get it for free. It's an option value, but if this thing does hit, if we can continue to drill it, likely with a JV partner, this has the potential to be, 10 million ounces kind of.
Yeah. So far, the results have been fantastic.
Yeah, well, this is exactly where we'll take you next, right? So we did one round of drilling when we first went public. I don't even think anyone knew who we were yet. But we go back and look at how spectacular results were. Hole number 2 here was 54 meters at 4.54 grams per ton. So that puts it in the top 1% of all gold intercepts drilled in 2021. We have 3 other holes, 1, 3, and 5, which were in the top 10% of all gold intercepts drilled in 2021. So significantly good results. We drilled into this window and into the trend, which basically comes to surface on our property. The reality is the next phase of drilling is going to be more expensive. So we're going to potentially look to partner up on this one, but there's no denying that there's something going on here, and this thing's got the best area code in Nevada, right? You're 30 kilometers south of the largest gold operation there. So again, we don't spend too much time talking about it. We know we've got something. There's a phenomenal option value there, but it's going to take some money to advance. But as I mentioned, this thing alone has the potential to be a company maker. So when you're looking at projects, especially Nevada or any open pit mining project, there's 2 very key things you need to look at. Everyone likes to look at grade. Grade is great, but it only tells you half the story. We like to say mining is like any other business in the world. It all comes down to margin. And there's 2 things in an open pit mining project that drive margin. Your grade, which creates your revenue, but your strip creates your cost. So those things together dictate your margin, which at the end of the day is going to drive your project economics. And you have to look at them together. And what we like to do, and this is the same way Barrick, Kinross, Newmont, all the big companies look at these types of projects, is you do a strip adjusted grade. So you divide your grade by your strip ratio, and your strip ratio is your ratio of waste to ore, how much waste you have to move, how much waste rock you have to move to get to your ore, which you're actually going to process. And when you look at that, again, these are all the projects, or most of the projects in Nevada right now, any of them with publicly available data. We have the highest effective grade open pit heap leach project. And if you go down that list, anything in the black boxes has been involved in M&A in the recent 12 to 18 months. There's not too many of these projects left. And we have the highest quality of these projects. So, the last one that we like to point to is Orla's railroad project, right? Which, is a higher grade, no doubt, at 0.77 grams per ton. But when you factor in the strip ratio, of 4.1 to 1, all of a sudden that knocks your effective grade down to 0.19. And again, as I mentioned, these are the two things you need to look at that are going to dictate the economics of these projects. So, we're in the best mining jurisdiction in the world, and we've got the highest effective grade open pit heap leach project right now. And the one step further you can take this is to look at recoveries, and we will do that once we have all the data back from our column and bottle roll testing that we're currently doing right now for Mountain View and Wildcat. So we like to take it a step further and show, we put out drill results. And again, Anthony, we were talking about spectacular grades of huge intercepts of 1.5 grams per ton. But we want to show you how even at 0.42, so our strip adjusted effective combined grade for Mountain View Wildcat, how you can make money. And what we've shown is at a $1,600 gold price, that gives you an effective strip adjusted in situ value per ton of rock of $22 American. And when you factor in the average cost to mine these deposits in Nevada of about $11 per ton US, that gives you a margin at $1,600 of $11 on 22, so 50%, right? So there's a lot of businesses and a lot of different sectors that don't have a 50% margin. So the point of this slide is to show you that whether the gold price is $1,200 or it goes north of 2,000, which we strongly believe it's going to, your margin is healthy. It's 30% up to 60% at a $2,000 gold price. So you can make money. You can make very good money with these low grade heap leach deposits because they're near surface and they're low capex. So this is how we stack up with some of our peers, North American gold exploration peers. As Anthony mentioned, sitting at about a $30 million market cap right now. We've got 1.2 million ounces that we will grow to 1.5, hopefully even more than that in the next resource update. Right now we trade at $20 an ounce. The whole sector has obviously been going through a tough time with the recent, economic developments and inflation and the rate hikes, and it's not been great for gold. But if you look historically, these high quality permitted shovel ready ounces in Nevada go for $90 plus per ounce. We're currently trading at 20. I just made a note, and then I always like to go back to this is, you've got Anglo Gold, which is one of the largest gold companies in the world, just bought an asset from Coeur, which has a current resource of 900,000 ounces. They paid $150 million for it. So that equates to over US $164 per ounce. So you can see why we're trying to remove all those key risks right now. So once those risks are removed, you start to see those values per ounce move into the $90, $100 range. And while we want to be the ones to develop and build these projects, if an Anglo or a Kinross or someone else wants to come and show us $100 an ounce, $150 an ounce, wants to pay us $250 million for the company, we're in the business of making money. We're more than happy to make money for ourselves and our shareholders and hand over the keys at that point. I'm just checking the time here. So I'll wrap up in the next few minutes and we can move to questions. But it is important that we touch on not only our achievements over the last year and a half, but also what's coming up for the company. We're brand new as far as companies go, only been in existence for a year and a half. In the last year, we've gone public on 2 exchanges. We've completed a 20,000 meter drill program. We've built a phenomenal team. We've drilled at Red Canyon, Mountain View, Wildcat, and we've also significantly increased the land package. And we're working to remove those big 4 key risks for the project. But we've also, in what's a pretty tough market, been able to raise $16 million in May, and a total of almost 40 million since the company was put into existence. So we have the ability to raise capital. We have strong supportive shareholders, and into next year, right? For the rest of this year, we're going to put out initial metallurgical results. So again, removing one of those key risks. We're doing the baseline studies to get the exploration plan of operations, which allows us to do that step out drilling. Next year, we'll do the resource update and PEA. So by the first half of next year, we'll have removed those 4 key risks and unlocked value in the ounces we currently have to garner those $90, $100 an ounce multiples that these things end up selling for. So finally, I'm just going to wrap it up and tell you what I told you, but we've got the right team, a team that's done it 7 times before, discovered 59 million ounces. We're in the best jurisdiction in the world. We've got high quality assets. Again, we will show you why. We'll remove those 4 key risks for these heap leach projects. We've got the ability to grow them. We've got top tier shareholders, the top mining investors in the world. And right now, I hate to see it, but we are deeply, deeply undervalued, like much of the sector. But we think, we're well positioned to deliver value to our shareholders as soon as this market turns. And even while it stays where it is, we're doing all the work to remove those key risks and again garner those high multiples that you see these types of assets trade at. So with that, that's all I've got, Anthony. I'll hand it back to you to do some questions from you or the listeners.
Yeah, no, I appreciate it. And we queue those up, if you could go back to that M&A slide, because I do want to touch on that. Thanks.
Sure.
But yeah, if you have any questions, please type them into the Q&A or chat box or raise your hand. If you can't do that, and I'll be happy to unmute your microphone. You can ask Jason directly. But obviously there are so many great things happening with this company. And I think unfortunately, we're seeing just the market, for exploration companies right now is a little soft. And I think this is definitely the time to start looking at some of these companies, especially with what they have on tap coming up in 2023.
I'm just going to jump in there, and it is unfortunate, but it's just part of the market, right? Yeah. Anyone who's done this long enough, these market corrections, it's a cyclical industry, right? If you don't want the type of returns you can see here, go buy a utility, right? Like that's part of the industry. And look, that was one thing that scared me of moving over to the corporate side, right? Is, it's a boom and bust industry, but when you surround yourself with people that have the ability to raise money, even in these down markets, and you have assets that are clearly high quality, you get a stomach to weather this sort of storm, and we're going to come out the back stronger. And if anything, what's going to happen is some of the lesser quality companies are unfortunately going to struggle and go out of business. But that money, those investors are going to have to find other good, higher quality projects. And we think we're in a prime position to take advantage of that.
Yeah, absolutely. And, and I think at these levels, when the sector is looking, a little bit out of favor, it's definitely time to take a look, because we do feel that gold prices will continue to increase over the course of the next year. And, there's an opportunity, excuse me, for a re-rating next year when the updated PEA comes out. And so now I think is the time to really take a long, hard look. But so looking at some of these, companies that were involved in recent M&A transactions. So I want to focus on the railroad project. So can you talk a little bit about what happened in that deal and how it compares to Millennial when you're looking at like valuations and things like that?
Sure. So Gold Standard Ventures have been around for a very long time, right? They drilled that asset out. They put out, I think recently, a feasibility study. So the highest level PEA first, PFS, then a feasibility study. So they had done a lot of work on these assets, and they had removed those 4 big key risks, right? Like they've done enough work on the met, the geotech was there. They've shown that there is some upside to, again, the reality is Orla of all companies is a phenomenal person or a phenomenal company to buy GSV, because they just put a very successful heap leach operation into production down in Mexico. But Railroad had a mine plan reserve of 1.2 or 1.3 million ounces. We're currently sitting at 1.2. We're going to grow it to 1.5 within the small footprint we're allowed to drill in right now, within that 5 acres. And at Wildcat, there's 17,000 acres. So we like to look at ourselves as a great comparable to Railroad, because we've got roughly the same resource size. We're going to do all the network, all the geotech, and again, remove those key risks to get us to that position. And at that position, they got taken out, at a $230 million valuation Canadian. We're currently sitting at 50. So it's a great comparable. You can look at us as a GSV or Railroad with growth. Plus, we have 4 other exploration assets from Waterton, plus Red Canyon, plus Cerro Colorado. So, there's a lot of option value there falling outside just Mountain View and Wildcat, but we've got a project that's going to be very similar in size and scale to Railroad.
Yeah, and I think too, the important thing is that when we talk about all the geopolitical issues going on throughout the U.S., throughout the world, the U.S. is definitely the safe place to be right now, and so that's what makes these properties, I think, even more valuable. And obviously with the drill results and in the strip grade and every strip ratio that they, Millennial is showing right now, it puts them as a premier property in that area with what we think is the potential, not only to succeed if they move forward and with their plan and start to to mine, but if they also they were to be taken out.
Like the reality, Anthony, is it's hard work to de-risk these assets, right?
Mm-hmm.
While you're doing it, you realize why companies don't do it. It's expensive, and as a pre-study asset, like the last thing you want to do is do all the work to realize, oh, you've got a crappy asset and you've got to put out a PEA that no one's going to like and is never going to get built, right? So we're doing all that work, and every step of the way, we get more and more confidence that these are going to be operating mines in the next 3, 4, 5 years, right? Like we can't give you an exact timeline on permitting because it's not within our control. Within our control is to do the right systematic scientific work to remove those key risks and to show growth and build the size of the economics behind the story. And we're very confident we can do that.
Yeah. And you guys have just scratched the surface on this property. There's so much more.
Yeah. And I think like the assets are one thing, but even the team behind it, right? You've got like the more experienced portion of the team that's done this 7 times. Then you've got, the other Jason and myself who are in our 30s. We're some of the largest investors in the company. We put our money where our mouth is. Jason Kossik's in for over $650,000. I joined the company just over a year ago. I'm already $150,000 in at prices well above where the stock currently trades. Because I know I've looked at enough of these projects, right? And I've got the stomach for it. So I'm happy to buy it 50, 60 cents Canadian a share, because I know that once we take out the key risks and get the updated permit, this thing is going to deliver from an investment perspective. I know, and I'm happy to hold it myself.
Yeah, absolutely. And it's a really good point. Management has put almost $1 million of their own money into this. Like I said, you have an opportunity to own the stock at probably half of what management owns it at in terms of the price. And then in terms of, institutional ownership, I've never seen a sub $100 million company have this kind of institutional ownership. Franklin Templeton, Eric Sprott. I mean, it's, Crescat, as Jason mentioned earlier, is really high on the, excuse me?
On Red Canyon.
On Red Canyon, yeah, and not even taking into consideration, the other two properties that, Mountain View and Wildcat. So, I mean, it's just a lot of really positive things happening. And I want to focus as well, Jason, on, this is open pit versus underground. Can you talk about the cost difference when you're looking at CapEx? Because that's really important for some of these companies, mining companies, that can get really bogged down with a huge CapEx for a project.
Totally. That's the reason why other companies, and I won't name names, but some of our peers have put out PEAs, PFSs that the market sees and nothing happens. Because if you're a $50 million company and you've got CapEx of 500, 600 million, how are you going to finance that? Even if you take half debt, you need to raise $300 million of equity. It's not going to happen. The projects that we have are much lower CapEx, right? Like, we're talking, again, we're working with engineers to figure out what exactly that number is. And as you can imagine, trying to do that in this environment where, I can't even go out and find a new pair of ski boots if I want to, never mind trying to put a price on large mining equipment. So we're working through that. But, I'll point you to I've got actually it right here. I was just reading it. So Minera Alamos just put out a PEA on their Cerro de Oro project. It's going to be about the same size and scale as Wildcat, and they're going to build it for $30 million US. I'm not saying this is going to be 30 million, but GSV, I think, had quoted for their initial CapEx as US 190. It's going to be somewhere in there. So it's not 500 million. It's not $1 billion. It's going to be a digestible amount that we know we can finance. And we know that, the market will get behind, and we have the ability to finance and put into production. And so from a CapEx, scenario, I think that covers it. From a mining cost perspective, it's the same story, right? These are near surface, heap leachable. You don't have to go underground. Your per ton mining cost is $10, $12, which allows you to make money at a 0.5 gram per ton deposit. When you compare it to underground, you need to have grades, in excess of 5, 6, 7 grams per ton to justify the cost of higher CapEx, and then your mining costs are 3 to 4 times higher. So it's not to say that you can't make money in underground, because you can, and clearly there's lots of operations around the world that can show that. But for the size of our company, the CapEx and the cost to put our assets into production are very feasible. And like we said, we'd love to do it ourselves. Do I think we'll get there? Probably not. But look, we would love to build a real mining company here.
Yeah, for sure. And I think it's, going to be the perfect acquisition candidate out there at some point. But you guys are moving along nicely. Did a very smart thing back in over the summer and raised some cash at a time when I think a lot of companies didn't do it, and they were kind of waiting. And now it's, I think, a little bit too late for a lot of companies at their valuations or where their stock prices are trading at. Where does this cash position get you to in terms of meaningful milestones?
Sure. So the cash we have now gets us through all the key milestones that we need to. Well, here, you know what? I was going to flip to the catalyst, but I think it's better for me to flip to this slide, because in terms of what garners a re-rate in the market, it's going to be removing these key risks. And so the $13 million of cash we have now will allow us to do all the met work, all the geotech work, to show the resource conversion and the updated resource, and to show the scalability by getting us the next stage of permitting, which is the exploration plan of operations. So we'll have all these boxes checked by Q2, by the first half of next year.
And I want to, I think, get ready to wrap it up here soon. But can you go to the land slide, the land acquisition slide? I just want to talk about, you know, when you look at mining in Nevada, you know, you want to look at the infrastructure, you know, where they are. And can you talk about, you know, roads, water supply, power, all that stuff, and kind of where, you know what you have there, because it is pretty impressive what you have access to.
It's as good as it gets. And again, from, you know, for our team that's worked in West Africa, you know, certain parts of Mexico where you need armored cars, you need security everywhere. You know, there's the geopolitical side, and then there's the environmental side. Like we're in the desert. There's no, you know, salmon spawning rivers. There's no trees. There's nothing, right? It's desolate desert that's within you know, an hour and a half drive from Reno. So it's like best case scenario, right? You can see here we've got roads that come right through the property. We've got access to water, power. You know, there's smaller towns within 20-30 minutes. That's why I joke, if you wanted to order a pizza to the mine site, you could probably do it. The infrastructure is there, but you are in the desert. So you get, and you're in the United States, so you get the best of all three worlds there. It's honestly, it's the best you'll ever get in mining, period.
Yeah, which I think, again, de-risks the property.
100%. And
100%,
you know,
yeah.
I didn't mention it, but as it's a great point that our CEO normally makes, is that 50% of the reason why mining projects do not make it is not because of economics. It's because of environmental or social, political, or something on that side. It has nothing to do with the actual deposit or economics, right? And so when we were looking to put the company together, to focus in Nevada, in a jurisdiction that you know you can build, permit, and operate mining projects, you remove 50% of that risk up front, right? It's a no-brainer.
Yeah, absolutely. And so I think with that, we're going to leave it there. Look, you know, I implore everyone to really take a long, hard look at Millennial Precious Metals and what they have going on. If you look at the investment highlights here, Jason just put up, I mean, they have high quality assets, obviously in an excellent jurisdiction. You know, about their shareholders, and we just feel that the company is undervalued compared to its peers. And we feel that, you know, if you look at what gold has done over the last few weeks, it's moved with the market, but it's rebounded nicely. And we think it's, even with the rates where they are, we feel like there's a strong future for gold. And we feel that this company, if they continue to do what they're doing in terms of, you know, moving forward with their plan, you know, they're going to start mining some, you know, some pretty impressive ounces. And if not, I think someone's going to probably come in and take them out, because it is, we think, the best in class in terms of, you know, properties in Nevada. So Jason, before we wrap it up, I'm going to give you an opportunity to just, you know, give us some parting words.
Sure. Yeah. Again, thanks for being here. And we know it takes guts to be even considering investing in mining companies right now, and never mind junior gold exploration. But we think, again, that presents a ton of opportunity. We think we're well positioned to be either the next big takeout target or the next big mining company. You know, as I mentioned, the name is who we are. We're the next group of mining entrepreneurs in the industry as millennials, and we're trying to do this differently and aggressively, and that's why we need, you know, this one to work. And we've set up the company to reduce risk for both us and you guys as investors. So we think we've got a really unique value proposition. And like, look, we're always available if you want to hear the story again, or if you want to dig into the technical side of the business. Myself, our CEO, our VP of exploration, we're always available. You know, you can find our contact information on any press release or on the website. Please reach out. We're happy to chat. And again, thank you guys for listening today.
Yeah, thanks, Jason. And if you have any questions, or you require any other additional information, reach out to me, or you can go to the company's website at millennialpreciousmetals.com, where you can see details on the company's current projects, as well as the latest press releases. A lot of great news coming up, drill results, as well as the PEA, which I think there will be a re-rating on the stock. So it's a good opportunity to maybe, pick up some shares and just put them away and wait for the news to come out. But I want to thank all of our attendees for taking the time to get up to speed on Millennial Precious Metals. I look forward to your feedback. The code word for feedback today is GOLD, GOLD. I'll send out the feedback link right after today's presentation. And as always, your timely feedback is greatly appreciated and very valuable, not only to us, but to our clients. So with that, Jason, I'm going to wrap it up. Thanks again.
Awesome.
And
Thank you very much.
I'll talk to you soon. Thanks. Bye, everyone.